Boy, is there a lot of stuff going on, some of which we've been cautioning now for several weeks. Watch for volatility around when it happens all over again early in 2026. There be volatility, meaning investments that react and people that overreact. Can't we agree that that's not a good thing? Too much of a good thing always works out to be too much of a good thing and will bite you in the behind. Chances are pretty good that we're going to see a shutdown, and it might even be one as long or longer. Hello and welcome to the Wise Money Guys radio show. I'm your host, John Scambray, and I'm not here with my partner, Giuseppe Viscani, who's off today, but it's going to be a really good show as always with lots of great information. But first, the Wise Money Guys are part of One Source Wealth Management, and we are a registered investment advisory firm, SEC number 319078. As always, for more information, you can visit our website, and you can get there many ways. You can go to wisemoneyguys.com, or you can go to onesourcewm.com. Both will bring you to the same place. You can scroll to the end of the page and see important disclosures and information, or there's other great resources on the page as well for you to look at and make a decision about whether or not we're a good fit for you. So today we're going to be talking about, and always talking about, investments, the economy, news, politics, and all the various things that impact people's financial lives. And boy, is there a lot of stuff going on, some of which we've been cautioning now for several weeks. In fact, I think we were the first to say, hey, when the government shut down and then reopened 43 days later, because they really didn't solve anything, meaning our elected officials, we said, this is going to happen all over again, and watch for volatility around when it happens all over again early in 2026. Well, here we are. So that's the big issue going on today, amongst many other things. But I'm really excited to officially announce, yes, our first dinner seminar of the year, which is going to be on March 4th. So hopefully the weather is nice, and we're going to do it at another golf course. Our last event of the year was at Granite Bay Country Club in Granite Bay, and we liked doing it there so much because we could control the noise and things much better than we can at restaurants. And so we're going to have our first one of the year at Woodcreek Golf Club, which is in Roseville. And if you're retired or about to retire and you're concerned about, or maybe you're not even concerned, but you're preparing for relying on passive income versus earned income, well, we should be hopefully one of, if not the first call that you make, because you only have one opportunity to start off right. And with everything going on today, it's so crucial that mistakes aren't made early on. We'll talk about what are some of the typical mistakes that people who are about to retire or are retired make when it comes to their investments, their portfolio decisions, their financial planning decisions as the show goes on today. But again, call us to register for our first retiree dinner seminar, which will be at Woodcreek Golf Club in Roseville. Very nice area, very nice golf course, very nice facility. Great food will be served. Refreshments will be served. We're going to start it a little bit earlier just because of the time that the meal will take. So we're going to start at 5:30 and we'll probably be done pretty close to 7 o'clock. At least we'll be done talking by 7 o'clock. We typically have people stay, 30 minutes, 45 minutes, an hour after, asking more specific questions about their particular challenges or investments, or just wanting to, talk a little bit longer and then maybe turn in their response form. That is the only requirement we have for attending. There is absolutely no obligation. The meal is included. As I said, it will be great food. The only thing we ask is that you fill out a response form. Tell us what you thought. Tell us how we could improve the content, if at all. And more importantly, put whether or not you want to meet for a no obligation consultation. And if you do, that is the call that you would get from us as a result of attending. If you don't, you won't get a call from us. So it's absolutely no obligation. We're committed to that, and no pressure whatsoever to meet with us. But I got to tell you, we always have somewhere between 10 and 15 people that do want to meet with us after learning why we're different, how we've been helping people who are close to retirement or are retired, continue building their legacy, building their wealth, generating and enhancing their income, enhancing their portfolio, helping them with estate planning decisions, helping them with tax decisions. Now, we're not tax advisors or lawyers, but because we are your quarterback, if you hire us, we help coordinate everything that you need that impacts your life financially. Actually, let's face it, if it impacts your life financially, it impacts your life altogether. And we help you with all of those things. So you don't need to go, seeking other professionals. We've been working with professionals in the area and have that all ready to go as part of our process, as part of our fee. The other thing to know is that we are affiliates, or affiliated, I should say, on the independent institutional side of the largest custodians in the country, such as Charles Schwab, which is our biggest and closest relationship, as well as Fidelity and some others. So if you already have a Charles Schwab or Fidelity or Interactive Brokers account, so on and so forth, often you can give us a try. You can hire us for a second opinion, and or hire us for, updating everything. Like I said, you're helping you update your estate plan, your financial plan, rebalancing, redoing your portfolio because you're changing from earned income to passive income, so on and so forth. And we do that on a fiduciary basis. That means we're not looking for commission products to sell you like annuities. In fact, I often say, and I haven't said it in a while, if somebody's trying to sell you an indexed annuity, be careful. I say run and give us a call, but be careful. There are instances where maybe it makes sense, but for the most part, what I've seen over the decades is people are getting sold indexed annuities, and they have IRAs, and they're using some of the insurance things that you can wrap onto the annuity as a good idea, that it makes sense that you're buying a tax-deferred commission product in a tax-deferred account, such as an IRA. I, most of the time, find that there was no reason to do that, and that the annuity made no sense at all, because you can get the same type of strategies where you have upside to the market through an index and don't capture all of the downside and have some, minimum guarantees, so on, and without buying a commission-based long-term annuity. I don't know how I got on that subject, but now that I'm on it, the other thing to know about annuities and why I'm not a fan and don't sell people annuities, because we don't sell anything, first of all. That's not what a fiduciary does. A fiduciary advises. A fiduciary looks to help you with things that are in your best interest, not our own. And when you're selling things that have a commission, well, the commission is not in your best interest. That's in the interest of the salesperson who's going to get the commission. So nevertheless, that commission is often not disclosed. And it's often anywhere from 5% on the low side to 10% on the high side immediately to the selling agent. Think of that right there. Agent. Agent means they represent the insurance company. Agent does not mean they represent you. Those are crucial things to know. So when you hear other shows or go to other seminars and they start pitching, a product that magically, captures some of the stock market upside without capturing, some or all of the downside. And, there's no, annual fee or advisory fee. Chances are they're talking about an annuity. They're talking about an indexed annuity, and they're going to make 5 to 10% up front. So if you put 100,000, 500,000, $1 million, I've heard some other shows on TV saying if you have $1 million, and then I know they're annuity salesmen, they're going to make $60,000, $70,000, $80,000 up front. That's years and years and years of our planning and advisory fee, which is one fee, by the way. We don't charge separately for planning. It's part of our responsibility to help you reach your goals and objectives now and for the rest of your lives. So more on that subject when we come back. In fact, when we come back, we'll talk more strategy, because that's what I went into. And we'll also have some ideas and other things to discuss. You're listening to John Scambray, the Wise Money Guy. Stay tuned. I'll be right back. Welcome back to the Wise Money Guys radio show. I'm your host, John Scambray. And I want to re-announce that and I got on a diatribe, we're having our first dinner seminar for retirees or people who are about to retire or are just concerned and want to know that they're in good shape to eventually retire. And in fact, we'll do a portfolio review. We'll give you a second opinion. We'll even do a retirement plan for you, all with no obligation, by calling 916-967-3500. But again, remember, our first dinner workshop, which we pull the covers back, open the curtains on exactly how we do things, but more importantly, why we believe we're different, why we believe that our way is the best way, and we try to prove it to you. And that's really what you'll see. You'll see exactly the types of process, portfolios, results, things that we think are helping and can prove that they're helping, our clients now and long term, and that our strategy and our active money management philosophy, one that starts with risk mitigation and ends with, income and growth and legacy, is one that you have to see for yourself. So call us at 916-967 to register for our March 4th, which is a Wednesday, from 5:30 to 7 dinner seminar for retirees, which will be held at Woodcreek Golf Club in Roseville. Again, call to register. By the way, I think there's a dress code. there was definitely a dress code at Granite Bay. So wear your Sunday best. No, not that any of our attendees have ever been in tank tops or cut off jeans, but boy, would that be kind of comical. But no, most country clubs, golf courses do have a dress code. So keep that in mind. Again, not that I should even have to say that, and can't think of a single situation where that would even be applicable. But just so you know, again, call 916-967-3500 to register. I don't know what the capacity of the venue is at Woodcreek, but I imagine that will be over registered. So don't wait. And we'll send you plenty of reminders along the way so you don't forget, via email, via phone call, just reminding you that you signed up and when the event is taking place to ensure that you don't forget. So the big news during the week, and gosh, I just get so sick of that. This is something that we need to look for. I'm so tired of Jerome Powell, the Federal Reserve Board, the FOMC, and that one agency, one person can move markets. In fact, when interest rates were basically left unchanged this week, the market sold off a bit. I warned people that there would be several headwinds, and I do believe they're cautiously, or to take caution, but they are buy the dip opportunities. Because let's think of the inverse. If you're leaving interest, I know, that everybody loves cheap money to borrow, including big companies, including money managers, institutions of any kind. We all love access to cheap capital. But if we're lowering interest rates, if we're easing monetary policy, which is really the job that we have, and the reason why we created the central banking system, well, then that means our economy's not doing well. That means, unemployment is high. Unemployment insurance claims are high. GDP is flat or negative. The dollar, is, and well, it is dropping in value, but I think it's a short-term drop, so on and so forth. So the fact that we're leaving interest rates where they are is not a bad thing. It's just the opposite of a bad thing economically. However, because it caused a dip, and just a dip in the week, not a dip overall, this is a record, more news for you, that the Dow, the S&P, and the NASDAQ, and I forget which one is which, but most of those three were up 8 or 9 consecutive months in a row, which is the longest consecutive up months for our overall, the majority of the stocks that make up these stock indices since 2018. So from a stock perspective, a stock market perspective, yeah, there's dips. From an economy perspective, there's news that causes reaction, that causes selling, that causes dips. But it's not because there's something fundamentally wrong with our economy. So cautiously, you should be buying quality, dividend-paying, interest-paying investments here if you're retired or about to retire. Also, this reminds you over and over again that, at some point you should lock in and rebalance some of your biggest profit positions. I'm not saying sell out completely, but how many times do you need to be reminded when something goes up and it hits, a new record or gets close to its record highs, and then it comes back down again, that you go, maybe I should have sold some of that. So, the strategy that we're talking about here is right now, dollar cost average, especially into positions that, again, everything looks good. We look at your basic fundamentals of a company, of the economy, of your investment portfolio, as well as the technicals. Is there momentum? Is there a pattern? Is there, a sentiment? Is there other indicators beyond just the fundamentals that suggest, it's time to stay in risk investments versus it's time to get out of risk investments? And right now, based on what we've seen, what we research, what we read, what we hear, what we do every day, it's time to be in risk investments. Now, again, caution here. That doesn't mean that you put 100% of your money in any one thing that has done incredible or any one category of things that have done incredible, because too much of a good thing always works out to be too much of a good thing and will bite you in the behind. So be diversified. Know that there's more ways to make money than just stocks. And within stocks, there's more money to be made on stocks than just AI or tech stocks. And that's really the power of what we do. It's really focusing on true needs, that focus on true diversification, to focus on true, protection of what you created, over your lifetime of earnings first, and then figure out what's out there to get you to the income or the growth or the goals, beyond the needs second. So that is just crucial. And when you do that, and when you do it with an air of caution, then, you don't have to worry about the dips or the corrections, right? For example, one of our stock models, if you will, which is made up of individual stocks, 10 of them, in fact, where we run a screen and do our selecting from and out of the S&P 500, just 10 companies. And then we look at the 10 every single month to see if they should stay the 10, what we call the top 10, or should there be a change? Some months there's a change. Many months there isn't a change. But that particular strategy and process that we use to pick those 10 stocks has outperformed the S&P 500 for the last 3 years. And in 2022, it also outperformed on the downside. Now, nobody wants to be, the tallest short person, but in essence, that's what that is. I mean, the S&P was down 19% roughly, give or take, in 22, and this was down less than 9% in 2022. So, again, it wasn't a reason to panic. It wasn't a reason to lock in losses. In fact, 22 represented a reason to buy, to invest into quality companies that, again, fundamentally weren't down because their company, maybe their growth slowed down, but they were still meeting, exceeding their earnings in many cases. Even during 2022, many companies throughout the year met their earnings. And earnings every quarter is a big gauge of the health of a company. We look at it quarter over quarter. We look at it year over year. We compare it to what's happening in the economy, what trend is the economy or the markets in, so on and so forth. And then if things still look good and a particular investment is down, if it's appropriate for your goals and objectives and what your financial plan says, we'll buy more. Just as if we have something that has run its course and it's time to sell it, we will sell it. Sell all of it, sell some of it, but we will sell, when necessary, where many people going it alone don't know when to sell. They don't know when to buy. So please come and see us at our March 4th dinner seminar for retirees at Woodcreek Golf Club in Roseville from 5:30 to 7. Call and register now because I know seating is limited. The meals are limited. It's going to be a good meal by calling 916-967-3500. And keep listening to the Wise Money Guys. I'll be right back. Welcome back to the Wise Money Guys radio show. I'm your host, John Scambray, and let's talk more about just good, sound principles when it comes to managing money. Just good, sound practices and good diversification and good rules of thumb to help you reduce your risk, but still maintain good upside when it comes to your investments. And so first and foremost, and as I mentioned, if you're investing in stocks, there is more than just the tech industry. So many sectors were much better buys last year and this year to start than just tech stocks. Okay. And so many times people get caught up in the headlines. So first and foremost, let's recap a little bit. Within each category of investment, don't get married to one sector or one particular position or company in that sector. It will be good as long as it's good until something comes out that, again, bites you where you don't want to be bit. So, we like to look for companies that we believe are undervalued, but also pay dividends and have a long-term track record of consistently paying those dividends and consistently increasing those dividends. Sometimes the rate of return you can make on your money doesn't have to be just on the gain side where, for example, I paid $10 per share, and if it goes to $20 a share over a 3, 5, 7-year period, well, great. That's how I made my money. I then sell whatever I bought for $20 a share. And then I realized that long-term rate of return of 100% over, hopefully it's 3 years, maybe it's 5, but more than likely it's about 7. That's one way to make money. We like companies that have that potential to do that, to increase in price over a long period of time. But we like companies that also pay a dividend. So while you're waiting for price appreciation, you're still getting paid. You're still making money on that investment while you're waiting to decide when it's time to sell and when it's time to maybe put the money in something else. So get paid for your time when you're investing as rule number one. I guess rule number one was don't put all of your eggs in one basket, truly. And let me get on a diatribe about diversification real quick. The mutual fund industry has done an insane job of making you think that when you buy different brands, different names of mutual funds, that you're diversified. Well, chances are you're not, especially if you have many different growth funds or growth and income funds that are just branded differently. Or my favorite, you have many different mutual funds that are different brands and they're just at different firms. That is not diversification. In fact, chances are you're duplicating what you have in your portfolio from one firm to the other firm. Plus, there's a strong chance that many of the top 10 holdings inside of the funds that you have are all the same. That's not diversification. Diversification is looking for investments that aren't perfectly correlated together, so that when one goes down, maybe it's not going down in the same amount. Or even better, maybe when a particular investment that you have is going down, something else is going up. That's what you look for when you're diversifying your investments. Is there something that has a lower correlation to what it is you already have? Does it have a lower standard deviation to the market as a whole? Does it pay dividends, or does it pay interest? Does it pay fixed interest? Is there any sort of, minimum guarantees or things that you can rely on? And a word about guarantee. There's no such thing that the word guarantee means that at no time will you ever potentially lose money. When it comes to investments, there's some things that are more risky than others. There's some things that you at least are guaranteed a rate of return. For example, you might not be guaranteed that the company doesn't default, but at least there's fixed and guaranteed on contractually what you signed up for. Even the government, even if you have, U.S. treasuries, you're not guaranteed that if you liquidate your treasury early, that you don't lose principal. The only thing you're guaranteed, for the most part, by a country that's working on $40 trillion in debt, is that you're going to get the interest, the coupon, the fixed amount that the government bond is promising you. That's about the highest guarantee that is out there. Otherwise, there is no investments that, and if anybody says you're 100% guaranteed, I guarantee you can't lose any money, I guarantee you're going to make X, Y, Z, please run and run quickly, and then call the Wise Money Guys at 916-967-3500. I didn't mean to be a downer, but that's the reality. And so true diversification, focusing on things that have a lower correlation to each other, focusing on getting paid for your time while you're in an investment, are all ways to help mitigate risk, to help ensure as much as you can that you'll achieve your goals for whatever your money and financial lives goals are over a long period of time, consistently and confidently. And in order to do that, you must know what you're doing, and I highly recommend you don't do it by yourself. In fact, I'm often surprised when somebody comes in, they're 70 years old, they've been managing their money themselves, in good markets like we've had right now the last 3 years in a row, they've done fine. Well, quite frankly, that's not when you need your professional helping you most. It's on the downside. It's on the emotion side, not making mistakes when things are volatile like they're going to be this year. News-wise, and I said, we'll talk about news and strategy as it relates to that news, so on and so forth. The tariff battle's coming next. We got past the inflation interest rate conversation in this Fed meeting that just took place, an announcement that interest rates are going to be unchanged. And now, by literally the end of this month, which in fact is today, the tariff conversation will be big next week. There'll be volatility, meaning investments that react and people that overreact based on what the outcome is. Do they pass a continuing resolution? Do they fund, the Department of Homeland Security, which, by the way, the Department of Homeland Security and ICE was already funded for 5 years in the big, beautiful bill. So this would completely be a shutdown that would have nothing to do with preventing ICE and DHS from doing their job, but it would stop the military from getting their paychecks. Do we really want that? I mean, can't we agree that that's not a good thing? Can't we agree that some of the other essential services and shutting down the government and them not getting paid? Again, I think it'll be a buying opportunity on the investment side. The volatility, helps to make our job when to buy, more clear than other times when you don't get, volatility that's not related to the economy or related to the performance of a company that you're investing in. So, again, don't overreact, but the next round of questionable policy that may affect your investments is the tariff battle coming this week. That's another one. The shutdown that is coming this week. So keep that in mind. And again, if you're unsure of what you should be in, if you're unsure if you're on track to never run out of money, if you're unsure if you're not getting the highest income, best growth rates, the best opportunities in your portfolio that you can with the least amount of risk that we can find, give us a call at 916-967-3500. And more importantly, keep listening to the Wise Money Guys. Stay tuned. I'll be right back. Welcome back to the Wise Money Guys radio show. Hope you've been enjoying the show so far. As things relate to what is going on with the government shutdown, I'm hoping this one is not as long as the previous one. However, that being said, I do think that certain sectors, certain investments will shrug it off without any problems whatsoever. There's things that are tied to the government shutting down, sectors that could see quite a bit of a sell-off. For example, defense. Companies that, provide, goods and services to the military. Energy companies might take a bit of a hit. Things that are subsidized by the government could take a hit, so on and so forth. But knowing that these things are going to happen, even though they're not guaranteed to happen, I don't know for sure the government's going to shut down next week. But if history is any indication of what our Washington representatives are capable of doing, well, chances are pretty good that we're going to see a shutdown, and it might even be one as long or longer. Now, I don't think it is, but again, I think knowing it's coming, knowing that there will be a reaction to it, knowing what types of investments that you have and how they'll react is crucial. So let us put our eyes on what you've done and what you're doing and what you have. Again, no pressure, no obligation. We'll give you advice and give you our opinions, and you can do something with that or not. Or maybe you decide that, shoot, I'm tired of doing this myself, or I'm not exactly thrilled with the value proposition of the current firm I'm working with, and want to give us a chance to help you. And so, that's my main point of this show is know that these things are coming. Know that there's good principles of portfolio management. There's good strategies, out there. There's ways to reduce your exposure to stocks, but still get, good potential returns on your money. What's funny is one of the things that we've really loved this year. Last year and this year. In fact, we just did one that we talked about last week is, these structured notes that there's no commission. You can get out quarterly. We can get you out quarterly if necessary, but it's a way to get a high fixed income with some downside protection on the market, which is priced very high here. In fact, this one we just did had a coupon, an interest rate fixed at over 10%. And at the maturity, if it makes it that long, and why I say that is often, these things get refinanced, they get called early, which is really what being called early is. It's a company going, heck, we put that investment out, we put that bond out, we put that note out, we put that out, and it made sense at the time to pay 10.5% or whatever the rate is. But now that doesn't make sense anymore, and it's a year later, and we're going to pay you back early, and you'll keep what interest you got, and you get your principal back as long as the market, when it gets called, this doesn't apply, but as long as the market in this particular last one we just did isn't down 40% at maturity, you get 100% of your principal back and all of the interest that you were paid over the 3-year term. So that's very interesting. That's a way to get a stock-like return without 100% stock market risk. Still have equity risk, still have default risk, but at least there's some barriers, there's some protection, there's some, flexibility versus just owning the S&P 500 index fund in your 401k or in your IRA or in your trust account. Whereas, heck, if the market's down 30%, the S&P down 30%, you're down 30%. Well, if this is down 30% when it matures, that's not 40. It could be down 39.99. That's not 40. And you get all of your principal back plus whatever interest you collected. That's pretty cool. Anyway, not to go into anything specific, but that's just an area and ways, and that falls under alternatives in your portfolio. So there's many ways and many investments out there now that firms like ours have access to because we're not an employee or a corporate owned. We work with the biggest corporations and best platforms in class right now, but there's nobody saying, oh, you have to sell this or do that. It is whatever is out there that we can find that you need, not what we need, what you need. And if there's a way to get you a 6, 7, 8% cash flow without, taking 100% stock market risk, we're going to find it. And quite frankly, over the last couple of years, there has been, between dividends, fixed interest rates, alternative dividends and interest rates, there's been 6, 7, 8%, cash flow investments out there that, we've been putting in people's portfolios that, I don't want to say our job is easy, but high interest rates have made our job a little bit easier to find people good returns on their money. And so with that, let's see. One of the things that I'll end with is that, again, if you're unsure of what you should be doing right now, if you're retired, if you've been, watching things go up and down, if you've not been happy with the firm or the value prop from whoever you're working with now, come to our workshop. Get a free meal in a nice venue, no pressure. I promise you will walk away thinking that's a good use of your time. We've never had anybody go, man, I wish I didn't go to that. I didn't learn anything. And how do we know that? Because of the response forms that we ask you to require, which is the only requirement to attending, getting the free information, getting the free meal. Remember, it's at Woodcreek Golf Club in Roseville on March 4th, which is a Wednesday, from 5:30 to 7 p.m. Call 916 916-967-3500. Again, that number is 916-967-3500. As always, I hope you enjoyed this week's show. I certainly did. Please come back and give us a listen next weekend. Have a wonderful Saturday. Bye, all.